bar is so high to be this kind of perpetual bear that if you think about it and you look at just the data, roughly 2/3 of the time, about 63% of the time, the market's going to be up on any given year, right? And so if you think about that just from a pure coin flip perspective, if you were flipping a coin and you had a 62% edge that I didn't know about, it's going to be very, very hard for me to beat you over any period of time. And I think that's the way people need to look at equities. In other words, if you're going to have a bearish thesis, and there are definitely times when we're bearish, we get bearish, plenty of times. But if you're going to have that as your starting point, it has to be a very, very, well thought out call with a lot of things lining up in your favor, because the ball is likely to tilt towards the bullish side, not the bearish side. So.
RenMac Off Script originated as a weekly internal research meeting designed to summarize and discuss what happened in Washington, the markets, and the economic data over the past week. It was always intended to be and remains a free-flowing conversation with no discernible objective other than to extract the wisdom and opinion of our analysts and their expertise. This is a conversation among colleagues. Individual circumstances are unique and nuanced. Do not mistake these conversations for investment advice, because it's not. Here we go.
All right, welcome to RenMac Off Script, where we openly discuss markets, economics, policy, history, and life. It is Friday, September 26th, 2025. I'm Steve Duttonoffer.
I'm Jeff DeGraff.
I'm Neil Dutta.
I'm Steve Pavlik.
And we got another new face on the pod this morning. Welcome, Sam Rowe. Sam is joining us this morning as a guest. Hi, Sam.
Thanks for having me.
You bet. So for those of you who don't know, Sam is an award-winning journalist in the financial press, has been writing for a very long time. He used to be the managing editor at Yahoo Finance. He was the editor at Business Insider. He now has a investment newsletter on Substack platform called Ticker.com, which, by the way, is a great story, which we'll get into, is how you came up with that name. It's probably not as obvious as you think. But Sam, thanks for joining us this morning. The last time we had a guest on was downtown Josh Brown. So no pressure, but he gave us a great tidbit on, was it Black Rabbit, to watch on Netflix. So at some point, you're going to have to give us something to take away in the movie business. So welcome.
I think importantly, Sam is also credentialed. He's not just a journalist. He's a CFA charter holder. He's an economist. He's credentialed. He just found his way into the publishing.
Well, it was the financial crisis that got me into the publishing business. I was actually sort of working on my plan to get into the Wall Street side of things, and I passed level 3 in 2009, which was great time to be pursuing jobs on Wall Street when a third of the industry gets laid off. So I had some odd jobs here and there, and then I responded to a tweet from Business Insider, and I ended up going in the journalism direction.
Well, and not only do you and Neil share a love of economics, but apparently one of your jobs to start was a compensation analyst. Both you and Neil had that.
Yeah, that was fun. I mean, I don't know what Sam's experience was, but I remember to be honest, I probably worked harder in HR than I ever did in economic research when I was at Merrill, because especially at the end of the year, I mean, like during the year-end bonus period, it was like late nights. I was always taking, they used to give car service back then to the employees if you stayed past like 9 o'clock or whatever. And I would always be getting like takeout, would always be getting car service home, up to my eyeballs in like, what was it, like McLaughlin? Because they had all the data on how much people in the market made. And, God, I remember I honed my MS Access skills. I probably did more VLOOKUPs in HR than I ever did in research.
I probably spent more time in HR than I did on the research. I don't know. We have a lot in common.
Hey, the other thing you got to talk about before Sam gets is it's autumn, right? So it's baseball season. So for those people who don't give a rat's ass about baseball now all of a sudden do, Jeff, you got any color? you're a long time. What bandwagon should I be jumping on now?
My color is pale. That's my color. That's the color I have. It's just absolute. The Tigers are on the fringe of a historic collapse from the All-Star game, losing a 15.5 game lead. They are now tied with Cleveland, who they played last night in a 3-game series. They're tied with Cleveland for the top spot in the AL Central. And now they're actually in Boston this weekend, who's also fighting for their lives to get a wild card spot amongst the Blue Jays and the Yankees. So I might find myself in Boston this weekend because it's actually consequential. And I mean, if you haven't been to Fenway, it is a fantastic place to see a ball game just because it's odd and it was also open the same week that the Titanic sank. So that gives you a little sense as to just how old Fenway Park is.
I went to school at BU, and senior year I lived in a brownstone on the top floor of a brownstone on Beacon Street, right outside of Kenmore Square, and one of our windows had a view into the bleachers in right field.
Perfect.
It was actually a nightmare. I mean, you know, as a college student, it's great because you're near all the bars, and whenever there's a game on, it's awesome. And you know, listen, if you've ever lived in Boston, it only takes like a couple of years before you become a Red Sox fan. But the reason why it was so bad was after the games would get out, you know, people clear out, but the stadium lights would stay on for hours. And they were so powerful that they would actually go through our blackout blinds. So, you know, whenever there was a game, we had lights in our apartment, you know, till like 1 a.m.
Well, you were young enough. You were probably just getting home at that time anyway, right?
Right.
Sounds like a party.
Yeah, good.
Well, a lot going on this past week. I want to kick it off with sort of where we are with the Fed. Neil, I know you were at a luncheon with the Myron, and you were at another luncheon with Mickey Bauman. What did you find out from those?
Well, I haven't gone to the luncheon with Bauman yet. That's actually later
there you
today. You know, I mean, I think there's a couple of ways to look at this. I mean, the Myron speech, I think, was, you know, frankly, a good one. And, you know, this is a point I made in a note to clients and to the financial press earlier in the week. But say what you will, but Myron has given us more in the last week in terms of his thought process around monetary policy than any of Biden's appointees did over the last number of years. And, you know, to me, I've always said it's irrelevant, like what he thought last year. I mean, last year, Myron was against rate cuts, and now he's for rate cuts. To me, let's just focus on the debate at hand, right? To me, it's like it's pointless to kind of litigate the past. Let's talk about what's going on now. And what he's talking about right now is that neutral rates are lower than people think, which means Fed policy is tighter than people think, which means there's brewing risk to the labor market side of the Fed's mandate. Now, you know, I would just say that I don't think neutral rates are as low as he thinks, because if that was the case, the economy probably already would have collapsed, and that hasn't happened. It's slowing, clearly, but I think he's right directionally. I mean, neutral rates probably are lower, and that's why it makes sense for the Fed to adjust policy. And, you know, Bauman, for her part, is making a lot of the same arguments. I mean, last year she dissented against a 50 basis point rate move. And this year, she's making many of the arguments that people were making last year when they supported the 50 basis point rate cut. And again, I don't think it's particularly useful to say like, hey, she's flip-flopping. I mean, that's probably true. People can make their own judgments about why that may be. But what's important is let's just fight the arguments at hand. And I think it's important to note that you know, there's a lot of enthusiasm. I mean, there was data that came out earlier this week. GDP growth revised up. You know, jobless claims remain low. But I think it's important for people to remember that the first quarter was actually negative. So how much of that is just a rebound from a weak Q1? And even though jobless claims are low, jobless claims have been low for a long time. That hasn't stopped the unemployment rate from going up 0.3% 2 years ago, 0.3% last year, and on pace again for about 0.3% this year, even though claims have been low the entire time. So, maybe we're kind of looking at some of the wrong metrics in terms of trying to judge what's really going on in the job market. And Bauman's been making that point, and she's also been highlighting housing, which is something that I've been increasingly concerned about. I mean, one of the things we learned this week, aside from the census not being able to properly capture the new home sales data, but what we know is that builders have basically reached their pivot point on margins. And so I think that means, how are they going to deal with that? And it's probably going to be some combination of like cutting back on construction, cutting back on workers, but they just won't be doing as much. And I think that's important. I mean, there's a lot of like, yeah, it's fine. Like you just said, growth is fine, GDP is fine. But at the end of the day, I mean, if you look at the ratio of like construction employment to housing permits, there's bloat. Like builders are probably holding on to more construction workers than they need. And if that's the case, we're probably going to see declines in residential construction employment, at least over the next couple of quarters, as builders right-size their business models and rationalize it. So is the market prepared for, I did a quick analysis, but basically it's around a couple of 100,000 jobs. I mean, if you were to normalize these ratios. And so if that's the case, is the market prepared for a couple of 100,000 residential construction workers being laid off over the next year in an environment where jobs growth is barely running 50,000 a month? So I think the economy can evolve in ways that people don't expect for reasons they don't currently appreciate. And, the way I feel right now, I mean, this is what Rosie must have felt like back in 2006. Honestly, I do mean that. That's kind of how I feel. I mean, it's sort of, I feel like I'm, screaming into the wind, but we have a process. We're going to stick to it. I think residential investment isn't collapsing, but what's different about what's happening right now versus what was happening a couple of years ago when residential investment was falling is that builders don't have a huge backlog of homes they have to work through anymore. And so for a given decline in residential investment, there's likely going to be an outsized decline in construction jobs. And
Sam, this seems to be like right in your wheelhouse. I know you have a piece out this week about, concerns you have for 2026. Is this part of that concern?
Oh yeah, I'm always worried about what's going to happen in the next 12 months or so. It's funny. First of all, when it comes to monetary policy in the Fed, I'm deferring to Neil all the time. I think one thing that I think people sometimes lose sight of when it comes to things like rate cuts is, you can cut another 25 or 50 basis points from here, but you will not be at a loose level of monetary policy. It's just getting less tight. So to Neil's point about, maybe we don't quite know where the neutral rate is, I think most people agree that it's lower than where we are right now. But in terms of concerns, it's sort of weird, like this, it's always a story, this whole idea of the stock market and the economy, not exactly moving one-to-one. And more recently, it seems to be increasingly so, with labor market metrics cooling and, a lot of, maybe the economy is still growing, but many metrics have started to, or have been flattening out for a couple of months, if not a couple of years. And yet the stock market is, just a few percentage points from an all-time high. It's funny. Some of the early 2026 outlook notes have been coming out in the last couple of weeks. And one of the funny things that appears is this idea that not a disastrous labor market, but a weak labor market ends up becoming favorable for profit margins, right? Because, suddenly workers feel like they have less negotiating power when it comes to their pay. Or I think Neil might have actually written something about this, a year or two ago, where when you have less turnover in the labor market, fewer quits, less hiring, less job openings being filled, um, you know, that means you're spending less time training new people or filling roles that highly qualified people were vacating. People are staying put, which means they know how the company works, and they know how the software works, and they know how the HR process works, and they know where the bathroom is, and they know what time, and all those little things that make you more productive as a worker. So in the, I don't think this is a great trend long term, but at least in the near term, this idea that the labor market isn't as hot as it used to be ends up becoming a tailwind for profit margins, which is one of the sort of pillars of the optimism for the stock market in the next year or two.
Well, let's go with that then on the stock market. Jeff, you had to report your weekly survival guide out this past Tuesday to clients, and you talked a lot about the yield curve dynamics, the impact it has on sectors and styles. You want to dive into that a little bit?
Yeah, sure. I mean, I think there's a couple interesting takeaways, but probably exactly as you would expect. The sensitivity in the markets is really back towards where we were pre-financial crisis, right? We talked about this last week a little bit, but if you look at kind of the impact, what are the most important things to watch? The steepness of the curve is obviously important. Twos and tens are kind of a default, but it's actually kind of in the more in the belly of the curve. The fives and tens, the fives and 30s, those actually end up being a little bit more interesting, and then the short end of the curve ends up being hugely impactful with a negative coefficient. That's technical stat talk for if one thing goes down, the other thing goes up, right? So as yields go down, equities go up. I think what's most interesting is what that impact is, and it's coming back to kind of a normalization. We didn't have that because of the financial repression, with the Fed and pinning rates down to roughly zero, and in fact negative real rates, right? But we're getting back to a more normalized environment that's happening globally. But what that really screams is cyclical versus defensives, and that's what we're seeing. The market's obviously rewarding cyclicality versus defensive names with things like staples making new lows on a relative basis and on an absolute basis in some instances as well. The trickier one is discretionary. So I hear what Neil's saying. It'll be a really interesting fight to see how that plays itself out in the equity markets, because historically those short rates are more important than the news flow. For the returns of those stocks within discretionary. So that'll be a big one. I think the other takeaway, which is a little bit of a curveball, and I'll tell you, and I maintain this, for the trillions of dollars that get traded in this business, the amount of presumption that goes on is just astounding. And so one of the presumptions is, well, if yields are coming down, that must be good for utilities and that must be good for REITs because they're bond proxies. And that makes all the logical sense in the world, except what tends to happen is as those rates come down, on a relative basis, the cyclical part of the market tends to catch the bid because that has the most beta or the most delta to those sensitivities of low rates. So if I think things are going to improve, if lower rates are going to help my cause, why do I want to buy a bond proxy? No, I want to buy something that's going to have a lot of juice. And that's why you end up with those things actually outperforming the cyclical part of the market, while the more defensive bond-like type of areas actually underperform. And it's statistically significant. So it's not just kind of a casual relationship. There actually is something that is persistent with that. So I think one of the bigger curveballs historically is, rates are coming down. Let's buy REITs. Let's buy UTs. Actually, that's just the opposite. You want to own those as rates are going up because that's when the economy is likely to slow because of those higher rates. So we'll see. But right now, if you kind of look at it traditionally from both a cyclical perspective and a market perspective, you've got short rates are coming down, which is good news. The curve is steepening, which historically is good news as well. So we'll see if that holds. But the equity markets are telling you the exact same thing. So we've got two, kind of independent indications that are in line and telling us what we certainly hope to hear and are confirming.
And not to throw a wet blanket on that, and maybe it's climbing the wall of worry so nobody cares, but we've got shutdown odds that are going up. We've got sectoral tariffs. We've got reciprocal tariffs on the horizon. Do we care, Steve?
Well, I guess from a market standpoint, I think usually if you look back historically with respect to shutdowns, I think they're largely dismissed for what they are. That's political brinksmanship. We don't really have usually much of an economic impact because ordinarily the furloughed workers get back pay when they return. Now, why that might be different this time is whether or not Trump pulls the RIF cord. That means reduction in force, and that is something that the Trump administration is threatening doing to use this as an opportunity to lay off a bunch of federal workers. There'll probably be a lot of legal challenges if we get to that point. We'd also have to see what the scale of that would be. But in that case, people wouldn't be looking at collecting back pay. So that may be a negotiating strategy heading into the talks, which will probably get more serious on Monday and Tuesday. It's really just, unfortunately, a byproduct of where we are in terms of political climate. But both sides sort of wait till the 11th hour when that sort of focuses the mind as to what the impact may be here. It really is just a high-stake games of chicken. You look back in March, Minority Leader Chuck Schumer basically, caved at the end. He made a political miscalculation that Speaker Johnson couldn't move the bill in the House without Democrat votes. He did, and he sort of, as I said, caved, and he didn't get any concessions. And that really has put him in a difficult spot politically because you have Democrats demanding they get some sort of concession this time, and Republicans feel that Schumer's going to blink again. So, sort of looking at the betting market right now, it's about 77% chance, both Polymarket and Kalshi, that we're going to have a shutdown. If you just sort of think about, are we more likely to shut down or not? I think we are more likely to do it. Might not be as high as 77, but I'm probably at 65 or 70, which is really high for me. Ordinarily, it's about a 20% chance. So we'll see, whether or not Schumer blinks. If not, then I think we probably are looking at one. And then when we get there, the question is, how do we reopen it? The last time Trump shut the government down in dealing with Democratic congressional leaders in the minority, we had the longest government shutdown in history. But that was only a partial government shutdown. We had 5 of the 12 appropriations bills passed. We don't have any of those this time. So we're looking at a full government shutdown. With respect to the sectoral tariffs, again, I think people should be anticipating more of these to come. Again, this is Section 232. These are more legally durable. These are not going to be the reciprocal tariff authority used under IEEPA that the Supreme Court may look at when they hear opening arguments November 5th. The intent is to bolster domestic production in strategic areas, and I think because of that, you're more likely to see these tariffs remain in place for a while. So you sort of look at the 3 announcements we had. Pharmaceutical, I think that's sort of been telegraphed a while from Trump. And if you look at the application, or key caveat here is that they're not going to apply to generic drugs, and they're also not going to apply to companies that have agreed to expand their presence here in the US. A lot of UK and European pharmaceutical makers have already done that. Presumably that's not going to apply to them. So I think that's important. With respect to the furniture tariffs, I think that may be a little more politically motivated. Trump mentioned in August.
Definitely national security.
Well, I'll let others weigh in on that, but he did mention Michigan and North Carolina in particular in his post in August, and that's important because they're obviously 2 presidential swing states. They're also 2 states where we're going to have very close Senate contests in 2026. I don't think that's a coincidence. I don't believe in coincidence as someone who lives here in D.C. And then I look at the tariffs on heavy trucks, and I sort of tie that back into a lot of these are assembled in Mexico. And it is legal to just reroute products to evade tariffs. But one of the challenges that the administration is trying to address is the idea of rules of origin. So when you have products from around the world, where they assembled, typically right now, it's where there's assembled, that is going to be the tariff rate applied. And so that's where you've seen countries like Vietnam, Mexico, where China just has all these products, they get assembled there, and then they evade sort of the tariff restrictions. So that's something they're still wrestling with, trying to address this issue of, okay, how do we alter these rules of origin to combat that, whether you're calling it transshipment or circumvention? And that's something that's going to happen. So I think people need to be prepared for that. So those were my takeaways on the tariff front.
Hey Sam, where are you on tariff impact?
I'm just mostly responding to paying attention to whatever the companies say on their earnings calls. I don't know how to. I'm not doing a great job of unpacking it from the economic data. And yeah, there's definitely signals coming out of there, but for the most part, I'm trying to figure out where the stock market is going, and so much of that just gets back to whatever the companies are saying. And for whatever reason, the company managements feel pretty good about profitability, profit margins, and managing all of this stuff. I mean, this has been in the pipeline for at least 6 months. And everyone seems pretty optimistic about their ability to mitigate tariffs with either pricing power or negotiating with vendors, et cetera, et cetera. I don't have that much faith. I'd like to see what happens in the next quarter or two. But so far, the lesson has been that it's not been the disaster. I mean, of course, there's the whole fact that a couple of things. Tariffs haven't been really implemented, and not to mention the fact that a lot of the stuff that we're currently seeing in terms of profit margins, might have been inventory that was purchased before the cost of this stuff went up. So maybe this hits on a lag. But I'm monitoring it carefully.
you and everybody else.
Well, we're also not collecting as much as we thought we would, right? I mean,
I thought we were.
No, we're not. I mean, there's the effective tariff rate as it's announced by the president, and then there's what we can actually collect at customs, because tariffs, for their part, while they have been raising more revenue than a lot of analysts expected, it is still a relatively inefficient way of raising money, especially when you have like a 20% here, a 50% there. I'm curious to see. I mean, it's going to be interesting, with this furniture tariff that goes in effect, I think next week, October 1st. I mean, Steve mentioned North Carolina, and go long Ethan Allen, short Wayfair. I don't know. I mean, it's sort of.
Well, but he also mentioned Michigan. I had no idea Michigan was big in the furniture business.
Huge.
There you go.
Grand Rapids, just south of where I'm from, north of where I'm from, was the furniture capital of the world for years.
There you go.
Until it got too expensive, and they all shipped off.
Right. So furniture.
All those good Dutch, craftsmen were out there, raising tulips, planing wood, all that good stuff.
All right, let's get to the mailbag this week. Harry, good morning. By the way, a little bit of a twist this week. We're offering up, in honor of the Ryder Cup, which is going on right now, golf balls, RenMac golf balls, if that's what you fancy. So you can either have RenMac golf balls or you can have a RenMac hat.
I hate to say this, but who represents the U.S. in the Ryder Cup?
What do you mean? Like who the team members are?
Yeah, who are our players?
Scotty Scheffler. You got Bradley Keegan is the captain. Should I go on?
I mean, do you know more?
You know what? This isn't the point of the podcast.
Okay, fine.
Off the top of my head, no, it's embarrassing. I should. We all should.
I don't.
Yeah.
I mean, if Scheffler wasn't, that'd be a crime. But yes. I really don't know.
Bryson's on there as well.
Okay.
So
that makes sense.
Two big hitters. And by the end of the pod, I'll get you the rest of them.
That's fine. No problem. We won't worry about it.
Harry, good morning.
Harry, golf is a game that we play that has a little white ball, and you hit it like 18 holes. It's a disaster.
You sure it's a little ball, or it's not a bigger ball like baseball big, like something like that?
No, it's a little ball.
Oh, okay. Understand.
Yeah. And the ones this week we're offering say RenMac on the side. So there you go.
Oh, that's nice. I saw those balls. I like it. I hope I can have one.
Yeah.
Maybe I bring up a question next time.
We'll send one to you. All right.
Okay. So today we have a question come from Dr. Thomas Dasaso. And he gave us his video. It's really appreciated. And let's take a look. Thank you.
Hi, gentlemen. How are you? I want you to know, first of all, really love the show on Fridays, RenMac Off Script. Incredible amount of information in a short period of time. My name's Tom Lasasso. Quick question for you. I think it's for Neil, primarily on productivity. Question is, what's the right way to be thinking about measuring productivity now, since everybody's looking for this big productivity boom that's going to enhance the U.S. economy, when we can measure output, but we can't even measure the number of people working? They just revised down the number of people who worked the last year by almost 1 million. So first of all, the question is the productivity number for the past year going to be revised upward dramatically that'll enhance your ability to think about a productivity boom happening because there's so many fewer people working because the government can't count properly? And going forward, how do you think, Neil, about productivity for different industries based on what the output is measured for that industry and the employees in that industry? What are you tracking for output and number of people worked. Thanks so much. Hope you guys continue to do well. Really love the show.
Look at that. Doc, thanks for the question.
I mean,
yeoman's work at Memorial Sloan Kettering. So thank you, one, for doing that, your service, and then thanks for taking the time to throw a question in as well.
all these videos are like, they're fantastic.
Yeah.
The production level is, and these really are like, this isn't set up. Like, we just get these submissions and they, 2 for 2.
I was going to say, I was about to not answer the question, because anyone that says I'm a doctor, if he was like an economist doctor, I'd be like, I'm not answering the question.
No, we had the scrubs.
But he was a real doctor, so
he's
I have
a real
to
doctor for a long time.
Yes, correct.
Go ahead, doctor.
Well, I'm not a doctor. As Sam knows, I proudly I always say I don't have a PhD. But at any rate, first of all, productivity is hard to measure. Everything's hard to measure in an economy as complicated and large and vibrant as the U.S. economy is. Okay, so I would just say.
First off, Neil, what's the traditional measure? The traditional measure
is a residual.
Correct, but walk through what that when you measure
labor productivity is basically output per hour, right? How many people how many hours are being worked and how much you're producing. That's
right.
Okay,
in terms of GDP,
yeah,
correct.
Yes. So just to, I would just say first, it's not that revisions are a feature of the data. It's not like the government can't measure. I would, just in the same way that people ask for a second opinion in the medical field, sometimes you need to do that with economic data as well. And you get more information. Like, there's like tax information that comes in and then the jobs numbers are updated because of that, right? There's business formation data and the jobs numbers are updated because of that. So the revisions are a feature, and I think it's really important that people understand that, not necessarily a bug of the US data collection process. Where there are no revisions? China. Okay, does anyone believe the data that comes out of China? No, they do not. In terms of measuring productivity, obviously a lot of the enthusiasm around productivity right now is around services, like IT services, white-collar professional services. And of course, it's much more challenging to measure productivity in that sector than it is in, like, let's say, manufacturing, where it's basically like, how many widgets are you creating and how many people do you have, right? It's much more, I would argue that it's probably a lot easier to measure productivity in the goods producing side of the economy. And as I was discussing earlier, you can make the argument right now that productivity is declining in the housing industry because there are too many construction workers relative to homes being built. So that's that's one point I would make. Look, if you just take the data as it's been coming out, it suggests that productivity strengthened in the recent quarter. Whether that's the start of something sustainable or just a blip in the data is something that remains to be seen. My own view is that employment tends to be the more stable measure of economic activity. And so it's likely that GDP growth probably moderates closer to where the employment data are. And so I don't think that we're going to get this ongoing boom in productivity that we've seen. I would also say, in my experience, when we're talking about lots of productivity growth, that's usually not when we see it in the data. Okay, it's that's the so-called like solo paradox, or the productivity paradox, the idea that the productivity is everywhere but for in the economic statistics, right? So it takes time for people to get the know-how to use. There's an adjustment period, right? Companies adopt the technology, but they try to, we see this in our own firm, right? We're using AI tools, but how do we integrate that into our process? And trying to figure out how to integrate it hurts productivity in the short run, right? In some cases, because you're trying to adopt a new process. Look, I would just say it's a challenging kind of thing to measure, especially in an economy like ours. I would say that right now, like, my reading of the data would suggest that productivity is not growing anywhere close to what it was in the 90s. It's probably growing around 1.5%, maybe 2%. which is okay, not the sort of great guns that people are talking about.
So just a couple things on that, Neil. First, isn't it true that in the service sector, like if they're measuring, let's just use RenMac as an example, because we're in the service business, they count us as 40-hour employees, right? Like that's kind of the standard where we're definitely putting in more than 40 hours a week, right? Now, sometimes it might be 60, sometimes it might be. Yeah, we're up.
So says the guy that's done the compensation stuff before. that's a weak hand, Neil.
All right, so maybe RenMac's a bad example, but generally in the service business, right? It is just presumed that there's a fixed number of hours, and that's not necessarily true. I mean, clearly the legal profession is different. The investment banking profession is different. The most economists' profession is different. So, there's that. And then the other thing I would just, want you to pull the thread on a little bit is what about the quality, right? I mean, I think one of the things that AI does is it kind of starts you off at a higher level with just a reasonably executed prompt that might have been, 2 days worth of research or work that you're already starting with in the first half hour, and you can now, dig deeper. So maybe your hours worked are the same, but the context of the output is of so much higher quality and deeper. How does that all play into the productivity calculation? Or is this just coming down to the number's a joke and it's really very hard to measure? And
I think the easiest way to see it is I'll put it to you this way. The best way we know we're in a productivity boom is probably if inflation keeps coming in weaker than expected. How's that? That's probably the best way to do it, honestly. You know how I knew we weren't? You know how you knew we weren't in a productivity boom in the 70s? Because inflation kept coming in higher than expected. If inflation comes in weaker than expected going forward, we're probably in a productivity boom. If the consensus is repeatedly revising up their GDP estimates year after year after year, we're probably in a productivity boom. I mean, that's to me like one of the best ways to figure it out. Like if you go back to the 90s, right, and you look at blue chip consensus forecasts, every year the consensus, like especially from like 96 to 2000, every year the consensus kind of started around 2 and ended up at 4. That happened for 4 consecutive years. And then if you go to the period immediately following the financial crisis, it was literally the opposite, where every year, you remember this, Sam, we were kind of like, it's going to start off at 3%. And then by the end of the year, like everyone's marking down their GDP number to 1, right? Like, so what explains that? It's productivity, right? Because productivity is notoriously difficult to forecast. So if it were me and you're trying to like look at this like a market participant, I would just say the ways to know is if inflation's coming in weaker than expected and the economy looks like it's still growing, and consensus forecasts. If consensus forecasts keep going up, then it's probable that we're in a productivity boom.
Sam? True?
Yeah, I think that last part makes a lot of intuitive sense.
From Neil,
your TV is getting bigger, but it's also getting cheaper.
Yeah.
I mean, that's got to be something, right?
Yeah. I was down in Georgia last couple of days with Howard Mason. He was a keynote speaker at the Georgia Securities Association conference. And he was talking about stablecoin and agentic AI. And you can start to see where all the productivity gains are going to come. He's going to have another conference call for our clients on this on Tuesday. We're just not quite there yet, but you can sort of see it on the horizon. So maybe that's going to end up being the big boom going forward.
So, Steve, I had a question. I had a question for Sam.
What do you say, Jeff?
Let me throw one thing in there because it just relates to that. I think it was in the journal, but I read, within the last 24 hours, that of all the firms that are implementing AI, right, in a meaningful way, less than 5% of them are showing a positive return on investment. So that speaks to Neil's point, right, which is you got to kind of get your act together and figure this out. There's a curve, and hopefully, once you get to that curve, you can start increasing that rate of return.
Yeah,
I think one of the headlines with studies like that is not so much, they haven't quite figured out, how to, generate savings yet, but maybe the headline is a ton of companies are looking into this and they're playing around with it. The uptake for all this latest iteration of AI, whatever you want to call it, I mean, frankly, it's just technology just getting better. But the uptake is just incredible. Like, the people who aren't technologically, fluent are picking up on this. There's kids, like little kids, are giving prompts to ChatGPT, and people of every age range, are exploring how to unlock value out of this thing. But yeah, I think to Neil's point, maybe we're still just sort of in the learning process.
I mean, last week I'm sitting. We'll get back to baseball. I was sitting there watching Detroit play Cleveland. Right? I know. The guy on first base. Detroit hits a double, stand-up double. There's no question. They send him to score. Right? With one out. So either way, you'd have had less than one out and runners on second and third if they didn't send him. And he was out by a mile. Right? And as a longtime baseball player and aficionado, I was like, that was not the right call. But I was thinking mathematically how to do it. So I put it in. I put the scenario into ChatGPT. Took me maybe 2 minutes, laid it out, and said, what as a third base coach, how should you think about this? Gives me the probabilities using historical references of how often you score and then what the expected run value is. And basically, it came back within 30 seconds and said, and it showed me the math, which I could have gotten to probably 2 days into it, right? I could have had an answer. Showed the math, and it said basically, if you don't have an 80% chance, you need an 80% chance of scoring successfully to send him. Otherwise, you're better off with one out on second and third. I mean, it was the blink of an eye, and it walked through all the math and the probabilities. And it was incredible.
Well,
obviously, that wasn't great for my productivity. It didn't really help, but it was just just kind of an example of just how quickly and efficiently these things can spit you back real good answers.
Well, the good news about that too, it probably explains how they lost a 15.5 game lead.
There's that. And I mean, wouldn't you think that at the major league level, you would have on the board like all these things that show the probabilities of what to do, and your only job as a third base coach is to memorize the roughly 30 circumstances that could possibly happen.
That's right.
Anyway,
Neil.
Good time.
Yeah, before we wrap up, I wanted to get, since we have Sam on the show, Sam has like the best one-liners, I think. Is very witty for someone in the investment business. So he has this line where he says, I'm cautiously optimistic in the short run. Sam, correct me if I'm wrong, and optimistic in the long run. And I mean, I get it. And I mean, he proudly says that his newsletter is a newsletter about the stock market going up. Now, Sam, I mean, let's say you got seed money to run a investment newsletter in Japan or in Europe or LATAM. Could you say the same thing? Like, this is a newsletter about why the stock market goes up.
Yeah, except it would be a newsletter in Japan about the U.S. stock market. I mean, there's a 45-minute answer to this, but I'll start with the 30-second answer, or maybe the 15-second answer. So the U.S. stock market, by market value, already accounts for 2/3 of the global stock market. So in many ways, it is and isn't the global stock market. And then you go even deeper. The S&P 500 accounts for 80% of U.S. equity market value. Something that has been a big topic of discussion, especially this year, is this sort of outperformance of the quote-unquote rest of the world stocks versus the U.S. And is this like a big paradigm shift? I don't think so. And my thought process begins with understanding the fact that the S&P 500 generates about 40% of revenue overseas in non-US markets. And that is also the case for stocks in non-US markets. If anything, more so. Publicly traded British companies do most of their business outside of the UK. Germany and Korea, all these other countries they're publicly traded companies, do most of their business outside of the local economy. So, just to sort of address, one fallacy, people make is when you invest in these countries or these, non-US stock markets, it's not about economic exposure. So it's got to be about something else. It's about, how these companies are run, how they're managed. Maybe it has something to do with how the executives are paid. Compensation in non-US companies is completely different from how executives and employees are paid in the US. There are even examples of the global CEO of a multinational non-US company getting paid less than the CEO of the US subsidiary because of the nature of how compensation and that culture works in the US in terms of running and operating companies. So I think there's something about everything from policy to culture to how the executives think, how the workers in the US think in terms of working and earning money and being an entrepreneur and taking a big risk or making a big investment in something that favors the US stock market and the publicly traded companies here. So I think it would be really interesting to start a newsletter from the perspective of a non-US market, but I don't think it would be as simple as saying, the Japanese stock market does XYZ thing, because it's a little bit murkier what's going on out there. Over here, everyone's interest seems to be aligned in seeing the earnings of publicly traded companies go up. Whether it's, people who have their retirement tied to, the company 401k plan or the company stock plan, or the managers who run the company that are paid totally in stock, all the way to, policymakers who need to make sure that they're implementing favorable business policies that facilitate earnings growth and stock price growth, because their voters and their constituencies, their retirements are tied to the stock market. So I think there's a lot of things that favor what's going on in the U.S. stock market. It's difficult to completely pinpoint, but I think there's something to do with the mix of culture and regulation and our desire to spend like crazy and buy massive houses that all favor whatever is going on in the U.S. stock market.
Good stuff.
Yeah. I mean, it's interesting because buy and hold really is a privilege for U.S. investors. It doesn't hold. Now, you could have said something different, in 1937, I'm sure, right? But you look at Europe, you look at Japan as an example, you look at China, almost everywhere else, it's tough, a much tougher slog. My quip to that is, and I'm sure I lifted this from somebody, but I'm a fully invested bear. Right. I mean, it's just like always looking over your shoulder, but invested. And I think one of the things that people miss, I mean, you would, I'm sure, totally agree with this. The bar is so high to be this kind of perpetual bear that if you think about it and you look at just the data, roughly 2/3 of the time, about 63% of the time, the market's going to be up on any given year. Right. And so if you think about that just from a pure coin flip perspective, if you were flipping a coin and you had a 62% edge that I didn't know about, I mean, it's going to be very, very hard for me to beat you over any period of time. And I think that's the way people need to look at equities. In other words, if you're going to have a bearish thesis, and there are definitely times when we're bearish, we get bearish, plenty of times. But if you're going to have that as your starting point, it has to be a very, very well thought out call with a lot of things lining up in your favor, because the ball is likely to tilt towards the bullish side, not the bearish side. So it
also matters how you define what it is to be bearish, right? I might need to revisit this in a more recent newsletter, but I wrote about this maybe 4 years ago, where I guess like the most bearish strategist on Wall Street predicted his price target implied like a 10% decline in the S&P 500 in the next year. And I made the case that that's actually bullish. because historically, in an average year, you see a drawdown that ranges somewhere between 10, 14, 15%. So as a realist who understands that investing in the stock market comes with some volatility, you have to be prepared for an average max drawdown in a given year in the neighborhood of 14%. So, to suggest that a strategist is somehow bearish because they think that the stock market is going to go down 10% in a given year, from my perspective, that's a big fallacy. But I like the way you characterize it as a fully invested bear. Like that's basically in line with my short-term cautious optimism. I'm always waiting for that next 10% drawdown, but I don't think that necessarily makes me a bear because my time horizon is much longer. And to your point, even in those years where you have those big drawdowns, in most years you end up positive anyways.
Right. All right. Let's get to what we're looking for this week. Steve Pavlik, what's on your horizon?
Well, sure. I just want to add, at least from my seat, when Sam was talking, I couldn't help but think about how President Trump always sort of focuses on the stock market as sort of a economic report card and maybe a political report card as well. I think it sort of fits in with what he was saying. But in terms of next week, look, Monday and Tuesday really focused on this government shutdown. I think that's when we're going to see serious negotiations occur. Sam mentioned cautious optimism. I'm cautiously pessimistic that they're going to resolve this by then. And I think that's important because we may not have Customs and Border Patrol agents going to work on Wednesday, October 1st, to collect the tariffs that we just talked about on the sectoral side. One, I'll leave you with an optimistic note, is watch this budding bromance in Brazil between President Trump and President Lula down there. Apparently, both men referred to strong chemistry after an unscripted encounter there at the UN General Assembly. And look, I think that's, dismissing that aside, I think there's optimism that, maybe they can sort of talk and reach some positive resolution here on some of the trade front. We have a 50% tariff on a lot of Brazilian imports, not all of them. There are some carve-outs there, and Brazil hasn't retaliated. And Lula also suggested he may be willing to make a pretty significant overture with respect to critical minerals and rare earths. And obviously that's a very strategic ally there, given their position in the BRICS, Brazil, Russia, India, China, and South Africa. So Trump said he wanted to see him next week. We'll see if that happens. But that's something to keep an eye on moving forward.
And the presidential race is kicked off with Kamala's book tour?
Well, that's the subject of speculation here in D.C. I mean, the question is sort of why is she doing this? Obviously, she didn't put her hat in the ring to run for California, the governor's position there, now that Newsom's term limited. Some believe that's because she didn't think she could win. I think she's somebody who, at least her team, clearly interested in preserving those 2028, potential. And I think this is an effort to sort of give her a version of events as to why Democrats should, look at her candidacy in the future more favorably. I think that's sort of the point of her book, is to say, here's why we sort of boxed in by Biden and why things would be different next time. And of course, she doesn't miss an opportunity to take a lot of shots at her potential 2028 Democratic rivals. So, I think that's probably the intent of the book and the book tour.
Got it. Neil, what are you watching?
I'll be watching all the private sector data. Because we don't know whether the government's going to be open to release the public data. We'll have the JOLTS number that comes out on September 30th, and the Conference Board Consumer Confidence, and we get ADP. So this might be a month where ADP actually takes on more significance because the payroll numbers may not come out. The upshot of all these numbers is that the president can't fire the people collecting them. If a shutdown is avoided, then we will get payrolls next Friday. But if it's not, even if the shutdown is avoided at the last hour, they could delay the payroll number. That could happen too. So we may not get a payroll data point next week either way. So all the private numbers, including ISM, will probably take on more importance in the marketplace.
Sam, anything you're watching this week?
I think everyone kind of stole it with potential government shutdown. I think if there's any good news is, maybe we've had a little bit of experience with this. We had data delays in 2013, which is really strange. And then, we kind of figured it out, I guess. I do think it's kind of concerning that the prospect of a government shutdown while tariffs are being rolled out and the Fed is in the spotlight, kind of creepily echoes of late 2018, where we did have, a 19% drawdown. So hopefully we don't repeat that. But one thing I am watching that's a little bit different, I think, is, Q3 is coming to an end. And, it's going to be a couple weeks before earnings season. But I'm listening for pre-announcements. If there are any companies that have to preempt their earnings announcement by saying that we have to revise our outlooks, maybe that's something to be concerned about. But if they don't say anything, then, get ready for another quarter of 60 to 80% of companies beating estimates by a margin of about 5%, because that happens every quarter. So whatever the expectation is for earnings growth for Q3, if we don't hear anything next week from, the companies preempting their earnings calls, then we should expect another strong quarter of earnings.
Okay. Jeff?
Well, first thing I'd say is kudos to Steve, because 2 months ago we were highlighting on this pod about the potential for a government shutdown, and people thought that was going to be impossible because didn't we just pass the big beautiful bill? How does that happen, right? And he helped to kind of navigate those waters for us to understand that these guys still can screw it up even after they get through that. So we were highlighting that at the end of July. So well done, Steve. I'm going to watch, breadth in the market, and there's a bunch of different ways that we do that. But I would say, the one that really stands out to me right now, it's about 40%, a little higher, about 43% of names within the Russell 1000 are above their 20-day moving average. That's a low number when you're at a new high for the Russell by itself. And so you'd want to see, either you're going to get a correction or a consolidation within that, where the kind of big mega cap names start to lose a little of that gusto, or the breadth starts to improve. And my suspicion is it's the former, not the latter, because the overbought condition that we have with a lot of these names, while the rest of the market is relatively tired. It's not a bearish call. It's just kind of a realism call. You don't need to chase things. You can expect, most stocks will pull back and consolidate. You want to be a buyer of those low volume consolidations versus chasing things higher. But that's what we're going to be watching. And then really, the focus for us will be on that discretionary call, because if that starts to fade, where discretionary loses, and again, we measure it on an equal weighted basis, but if that starts to fade relative to the market itself, that's a more bearish picture for the economy and what the market's seeing. In other words, things are bad. Things are worse than the Fed cuts are good, right? So it's kind of like, where are we right now? Right now, the Fed cuts and lower short rates are better than what the market's expecting the data to be. If that starts to deteriorate, that means that the Fed's going to be behind the curve, and that would be obviously a yellow flag, if not a red flag for us, for the market overall. So,
all right. Well, that's great. Let's end it there. I'll remind everybody to follow us on X. Go to our YouTube channel to see us if you want to watch this podcast. And then reach out to RenMac.com or go to RenMac.com, I should say, to see more of what we do. Get a free trial if you're not already a client. We'd love to have you on board to see what else we do beyond just this pod. But Sam, I want to thank you for being on our show today. Really appreciate it. You're welcome anytime.
Thanks for having me.
You bet. And we'll be back next week when we'll be 1 week older and 1 week wiser. I'm Steve Duttonoffer.
I'm Jeff DeGraff.
I'm Neil Dutta.
I'm Steve Pavlik.
And that's Sam Rowe. Take care, everybody. Thanks.